One of the stocks that I've now owned in my personal dividend portfolio for a while now is Texas Instruments Incorporated, stock ticker TXN, currently trading at $158.65 per share. Now, over the past year, the share price is pretty flat. It's only down around 1%, but if we look at the past 6 months, it's now down over 10.3%. So the question we need to answer is Texas Instruments trading at $158.72 a good price to consider buying in at? In this video, we need to address that. Let's go ahead and start by looking at some of these dividend metrics. We can see the current starting dividend yield for this company sitting at 3.23%. And speaking on the dividend, they actually just recently announced a new dividend increase. You can see it was a 4.8% dividend hike, making their dividend payout $1.30 per share. That was a decent hike of 4.8%. Let's go ahead and look at the dividend history for this company. Click on dividend history and scroll down. We can see they've done a phenomenal job of increasing their dividend payouts over the past decade. In 2013, they were paying out around 21 cents per share quarterly, and jump forward to now, we're now sitting at $1.30 every single quarter. And if we look at those dividend growth rates, it's been really good over the past 3, 5, and 10 years. The 3-year dividend growth rate sitting at around 11.2%, 5-year 14.87%, and the 10-year sitting at 17.6%. Those are really phenomenal dividend growth rates. So the starting dividend yield, dividend growth rates, and dividend history all look phenomenal, but obviously the big question we also need to answer is dividend safety. All this means nothing if the dividend is not safe. So my favorite payout ratio to look at is the cash flow payout ratio, because dividends are paid out of free cash flow. We can see their cash flow payout ratio currently sitting at around 61.85%. Typically, for a dividend stock to be able to really increase its dividends by a large amount over time, you want to see the cash flow payout ratio closer to around 20 to 40%, but I don't necessarily think this is a bad cash flow payout ratio. Now, of course, I do also want to jump into a valuation of Texas Instruments, but before we do that, I actually want to jump over to their investors relations page and point out some of my favorite things about this company. If we look at this page, we can see the very first thing you see here is a quote from Rich Templeton, the chairman of the board, and it's actually a phenomenal quote. He says the best measure to judge a company's performance over time is growth of free cash flow per share. And we believe that's what drives long-term value for our owners. Now, if you've been watching my channel for a while, you know this quote is pretty much exactly what I always preach. We should be looking for companies that are able to increase their free cash flow per share. In my opinion, this is probably the most important metric you can be looking for as an investor. So obviously it excites me to see the company is focused on increasing that metric over time. If we scroll down, you can see they have a focus on free cash flow per share, which leads to dividend growth and also the ability to have share count reductions, which is a great way to add value to shareholders. Now, if we jump into their investors presentation again, there's quite a bit that I do want to go ahead and point out. Now, we can see here on the executive summary, they run the company with the mindset of being a long-term owner. That's a good sign. And like we just saw, they believe that growth of free cash flow per share is the primary driver of long-term value, and I 100% absolutely agree with that statement. Now, if we jump over to the 9th slide, let's start to actually dig into this a little bit. One of the most important roles of management in a business is learning how to properly allocate capital. And one of the reasons that I personally own Texas Instruments is because I think their management does a phenomenal job of properly allocating their capital. Now, when it comes to allocating capital, there's really 5 things that a company can do, and this is something that I talk about on my Twitter account. You can see here with free cash flow, there are 5 different things a company can do, and this is different ways to allocate capital. They can reinvest for organic growth, they can pay down debt, attempt acquisitions and takeovers, they can pay out dividends and buy back shares. So if we jump back over to the investors presentation, they pretty much talk about what they've done over the past decade. Now, the largest focus with their free cash flow has been reinvesting it back into the business so that they can see organic growth of the business. I think this is one of the most important things a company can do. They should always be reinvesting capital back into the business so that they can continue to grow. If they can continue to grow, this allows them to do things like increase dividends over time and attempt more share buybacks, which is exactly what they've been doing. You can see they've had a large amount of share repurchases over the past 10 years, which is essentially just another way to reward their shareholders. And they've also been paying out dividends, and have been increasing those dividend payouts for quite some time, like we've already seen. Now, the fact they're so aggressively reinvesting back into the business really allows them to focus on what they think is important and what I think is important, and that is free cash flow per share, which we've been talking about. And you can see Texas Instruments free cash flow per share since 2004 to 2022 has been increasing by a rapid amount, which is again exactly what their management has been seeking to do. And like I mentioned earlier, the result of seeing really good free cash flow per share is you can see sustainable and growth of their dividend payouts. And dating back to 2004, you can see they're paying out around 9 cents per share in dividends. And in Q4 of 2022, those dividend payouts were $4.96. And keep in mind, we did just see that recent dividend increase. So from a dividend growth perspective and free cash flow growth perspective, historically speaking, they have been doing really well. And like I mentioned earlier, they haven't just seen growth in dividends, but they've also been able to reduce the amount of shares outstanding by a very large amount since 2004. They have seen a 47% reduction in shares outstanding, giving more ownership to their shareholders. So with all of that being said, one of the reasons I personally love Texas Instruments is simply their approach to capital allocation, but that doesn't account for the fact that at their current trading price, is it still a good value? If we jump over to the summary tab and look at the past 10 years, you can see they have outperformed the market up almost 300%. So again, is it at a good value? Well, to find that out, we do need to jump into my stock valuation spreadsheet. We'll be looking at a few different valuation models, and like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in Texas Instruments and hit enter, and you can see this data will automatically load in. We've already touched on the dividend metrics just a little bit. We can see the 20, 50, and 200-day moving averages all down by quite a bit, and analysts currently have a target price of around $186.70, institutional ownership around 86.5%, and a beta sitting pretty close to 1, so the volatility should be pretty close to that of the market. Now, the first valuation model we will be looking at is Graham's valuation. This is a valuation model invented by Benjamin Graham to calculate intrinsic value, so we need to plug in all of these different metrics. We have our earnings per share, we have our growth rate projection, and I'm staying in line with analyst projections. We multiply that by 4.4, and then divide by Y, which is our current yield on AAA corporate bonds, and at the time of this video, it is continuing to climb higher and higher, which is going to push down this valuation by quite a bit. Current yield on AAA corporate bonds is sitting at 5.15. This actually gives us an intrinsic value of just $128.10 per share. Now, just a few years ago, the current yield on AAA corporate bonds was sitting more normal at around 3.5. And you can see if that was the case right now, the intrinsic value jumps all the way up to around $188.50. So basically all I'm saying is current market conditions are really pushing down this valuation by quite a bit. Now, the next valuation model we'll be looking at is the discounted cash flow analysis. This is one of my favorite valuation models because it simply values a business based on how much cash flow they are going to produce in the future. So basically what we need to do is project a growth rate for the future free cash flows. So I analyze the historical free cash flows and look at analyst expectations, and I'm projecting a free cash flow growth rate of around 11%. For the future free cash flows, I found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, subtracted out total debt to get their equity value, divided by shares outstanding, and came to a discounted cash flow price per share of $192.45. Now, the next valuation is the multiples valuation model. Basically, we're seeing how the market is valuing companies that are similar in structure to Texas Instruments. We're taking their stock price, dividing by earnings per share to get that price to earnings multiple. We take the average PE, multiply it by Texas Instruments earnings per share, and we come to an intrinsic value of $185.22. And the last valuation model we'll look at is the dividend discount model. This values a company based on how much they pay out in dividends and how much that dividend is increasing year over year. So I plugged in those dividend payouts, including the new one, so we can see those year over year dividend payouts and the year over year dividend growth rates, which are pretty strong. It's an average growth rate of around 9.69% over the past few years. So moving forward, I'm projecting a dividend growth rate of 6.25%, discount rate of 9%, and that gives us a dividend discount model price per share of $200.91. So when we jump over to the output tab, we can see the four valuations that we use. We have Graham's at 128, multiples at 185, discounted cash flow at 192, and dividend discount model around $200.91 per share. When we average all four of those together, we come to an intrinsic value of $176.67. So with a 10% margin of safety, you can see this company is within our acceptable buy range, sitting at $159. And with a 20% margin of safety, our acceptable buy price sitting at around $141.34. So with a 20% margin of safety, it's not quite in that buy range. So there you go. There is a quick analysis on Texas Instruments. Go ahead and let me know what you think of this company in the comments down below. Again, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.